Yes, hi, Kevin here again, and today I wanted to talk about something that I've enjoyed over the last number of years, and that's reading about behavioral finance, also known as neuroeconomics. And today I have an example of a way that we can think about investing differently, because we are our own worst enemy when it comes to investing. Your Money, Your Brain from Jason Zweig, Simple Wealth, Inevitable Wealth from Nick Murray. I've also read the Predictably Irrational series, which is also the upside of irrationality. And all these authors all say the same thing. We are our own worst enemy. So if you'd bear with me in a thought experiment today, I'd like to pretend that today that I'm your rich uncle, and I'm a benevolent rich uncle, and I come to you and I say, I'm going to give you $100,000. $100,000 I'm going to give you. And but there are a few strings attached to this $100,000. First of all, you have to invest it in equities. Second of all, you have to not touch it for 20 years. If you try to touch it, all the money comes back to me. And finally, you're not allowed to look at your statements. We will have an independent auditor look at your statements every year and just send a letter that says, yes, the money is still in there and it's about what it should be, or it is what it should be. So those are the three things. Okay, that's all you have to do. Now, let's pretend now we're in the 19th year. And in the 19th year, again, I'm a benevolent, but I'm kind of a devious uncle. I come to you in the 19th year and I say, hey, I put another $100,000 in a CD in the bank, and you can have that. Or you can go ahead and wait one more year and take your money that I invested for you in the S&P 500. What would you prefer to do? Well, at that point, you probably would go back, if you're intelligent at all, and see what those first 19 years were. And I'm sure looking at a 3% interest rate for, let's say, for CDs over that time period, when we look at a 3% interest rate, you would have $180,000, a little over $181,000 out of that $100,000 for waiting 20 years if it was in a CD. Then, on the 20th year, if you decide to reject my thought process around switching out for the CD, and you end up holding on to it, let's use last year's returns for the prior 20 years, because last year's returns were pretty good, but we've been through one of the most rocky, up and down, volatile times, at least in our lifetimes, and most people's lifetimes that are still around. And so last year would be a great example to go back 20 years and say that would have been the return for the next 20. Not that future results are predicted by past results, but anyway, if we just looked at the 20-year prior return, you would have $470,000 based on that return. And my point here is that when you don't get to look at your statements, when you don't get to mess around with the money, when you can't buy, sell, and trade, when you can't do all these things and it just sits there, the reason why investing is not gambling is because over a 20-year period, you're going to receive the dividends and the earnings brought back to you in a higher stock price by just holding on to it. And with the S&P 500 or other major indexes, there's not a worry about monitoring and making sure the company, you're going to have good and bad companies within the S&P 500. There's going to be good and bad, but you hold the whole index, and over a 20-year period, you get 8%. So why can't we do this? Why are we stuck in continuing to monitor our portfolios? And why are we so fearful that we keep all our money in the bank, or some of us do, keep a large majority of our money in the bank? Well, it has to do with the short-term fear. And especially Nick Murray says that, the job of the advisor and the job of the investor is to agree together that you're going to hold on through thick and thin. Because even though this person, you, who are my nephew or niece, got $470,000, you still probably went through some major ups and downs, but you could never look at your statement. So all I'm advocating is to think about this. Thank you.
So here's the data that your uncle is using. The year that he was born, 8.66% 20-year annualized. And then in 2012, it was 8.21, 20 years going back to 1993. That's where the 8% comes from. If you invested in CDs at a 3%, you would have $181,000. And then if you invested in equities, S&P 500, you'd have $470,000. What a major difference.